there. Welcome back to Elements in Focus. So glad you're with us today. As always, I got our Director of Financial Planning, my partner in crime, dear friend, longtime colleague, Rheaume here with me today. And what he's going to do is we're going to talk about what is an inherited IRA.
Yeah.
And as this wealth transition is taking place in our country, this is going to become a very deep topic for many of you who are watching. And so we're glad we're here to provide some good basic overview of some of these terms. And it's part of our tax planning section of our 5 critical elements. And so inherited IRAs are unique vehicles that come with some great nuance with some tax code changes. And Aaron, when we talk about what is an inherited IRA, what are we actually looking at?
Thanks, Grant. I'm just going to be in the most basic form. An inherited IRA is a type of retirement account that is passed to a beneficiary when someone passes away. That is the most simplistic form of the account type. You can't add money to it, but there are a lot of decisions that have to go around planning for leaving IRA assets and also receiving inherited IRA funds. Now, in the open, you had mentioned that there's some tax changes that have happened to inherited IRAs. And you're absolutely right. Those changes took place in the first part of the Secure Act, which was passed in December of 2019, went into effect in January 1st of 2020. And what had happened was there was a major rule change on how beneficiaries could receive those dollars. If it's a spouse, you can inherit that as a spousal inherited IRA and roll it directly into your name. Now, if you're a non-spouse beneficiary, there's some things that you have to pay attention to. You used to be able to stretch out an inherited IRA over one's life expectancy. That was called the stretch IRA. Some of those are still out there prior to 2020, where there's people that actually have IRA accounts, inherited IRA accounts, where they can take the required minimum distribution or a distribution over a period of time that's stretched out over their lifetime. What had changed in 2020 is that is now a 10-year window. Let me say that one more time. A 10-year window. So if you receive IRA dollars and you're a non-spouse beneficiary, you are going to have to take those funds out in a 10-year period of time. Why is that a problem? Grant, do you want to just briefly elaborate on that? I'm going to steer you to the point that you always make about the IRS is not silly in this, pushing RMD's ages back, right?
Yeah, 100%. And so, the caveat to that is the IRS knows what they're doing,
Mm-hmm.
right? They know what they're doing. They're coming after the money and they want it as fast as possible. And they don't care if the original owner of the IRA takes in their lifetime, because here's what they're anticipating. As many heirs do, they receive these dollars later in life. And what's happening to those heirs? They're making the most money they've ever made. And so they get
Correct.
to tax those dollars at a higher income level. Aaron, is that what you were going for?
Exactly. You nailed that exactly. And that's the reason also why the stretch portion of that IRA went away, is because the IRS now wants their dollars in a 10-year period of time. And as Grant mentioned, it's generally when most beneficiaries are going to be at their highest earning years. We reference Joe, our managing partner and co-founder, a lot. He's very, very in tune with the demographics of our population. And what Joe tells us and what we know to be fact is the largest portion of our baby boomer generation has been born between 1957 and 1961. So think about it. If you're born in 1957, you're now 69 years old or will be at some point in the year. 1961, that means you're turning 5 this year. Yep, 65 this year. So there's a vast majority of people that have been born between 1957 and 1961 who are now 65 to 69 years old. That's going to be moving into those required minimum distribution ages. And the other thing that happens from a tax standpoint is that RMD age has been pushed back, not again because the IRS is doing it in your favor. It's because when your spouse passes away, your tax bracket gets cut in half. And so IRA dollars can be significantly taxed at a higher rate because you lose the ability to do married filing jointly on your tax return. So when you think about IRA dollars and when you think about future planning around those IRA dollars, we have to plan for those all of the time and not just thinking about what happens to the taxation today, but it's forward thinking. What happens to the taxation 5 years from now, 10 years from now, 20 years from now, and when it passes to the next generation, in which tax bracket are those folks going to be inside of that next generation upon when they receive the funds? Here at FEG, at the Financial Enhancement Group, we have many, many conversations around proper proactive tax planning to help reduce and mitigate the responsibilities of passing on a large tax bill to heirs. And we do that through strategic giving. We do that through concentrated Roth conversions, moving money out of IRAs into Roth IRAs so that we're avoiding future taxation. And one last thing on an inherited IRA is when people receive it, sometimes the distributions are often missed because they didn't know that they were supposed to take a required minimum distribution. And those get complicated as well, depending on whether the owner of the IRA was already taking RMDs. And so if you have an inherited IRA, and if you're thinking about passing on IRA assets, you need to have a conversation with a professional, with a fiduciary professional, to help you understand how that's going to affect your taxes today, tomorrow, and the next generation. So Grant, if someone wants to do that, how would they reach out to us?
Absolutely. So if you're someone who's trying to figure out what to do with an inherited IRA and you're a spouse and you're trying to make the best decision, like Aaron said, if you're someone receiving an inherited IRA or an inherited Roth IRA and you're trying to figure out what the best tax consequences, distribution rates are, and if you are essentially managing a trust or thinking about putting retirement assets like an IRA or Roth IRA in a trust, you absolutely need to have a conversation with someone like FEG. And how you do so is you get in touch with us by 800-928-4001. One of our top team members will pick up the phone, get you scheduled with our team member, or one of our qualified advisors to go through the situation like Aaron stated. And if you have specific one-off questions, please don't hesitate to use Talk to FEG at yourlifeafterwork.com. And going back to all of our calendars, so all of our advisors are qualified to have these conversations. And you can get on our schedules at yourlifeafterwork.com. And if you click the QR link that's in the video here today, it will go directly to our calendars. And so you can find out who's closest to you and then engage in that discussion and start unpacking something that seems simple, but yet is very, very complicated. Aaron, thank you for going through this. I mean, it's simple, yet it's complex. And you did an excellent job of kind of laying that good foundation for us. So folks, thank you for the time as always. And if you're going through these questions or you're starting to think proactively about planning, please reach out to us. But until then, we'll see you next time.